Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday the 9th of October. My name is Steve Brice and I'm your host for today's podcast. Forget about the outlook. Even the current state of the US economy remains unclear. Friday's data is a great case in point. Job creation was much stronger than expected, especially given the upward revisions to previous data releases. On the other hand, consumer borrowing fell sharply. It appears that higher debt servicing costs, both due to higher interest rates and the resumption of student loan repayments, as well as higher oil prices, are starting to have an effect. Just to put this into context, consumer credit has only fallen this much 5 times before in history, either in the depths of the global financial crisis or during the pandemic. It'll be interesting to see the tone struck by major retailers during the ongoing earnings season. Against this backdrop, the narrative for high interest rates for longer is even stronger than it was a week ago. Minutes from the September FOMC meeting are unlikely to change this. More important, in my view, will be the inflation data out of the US also on Thursday. While the year-on-year rate is expected to continue falling, a 0.3% month-on-month increase in core inflation, obviously annualizing almost 4%, may raise concerns about the pace of future declines. Absent overwhelming evidence that the economy is heading to recession, therefore, the Fed is likely to keep talking at least, and maybe even acting, hawkish. What does this mean for bond markets? Well, in the short term, yields could still move higher. Fed hawkishness remains the default setting. Meanwhile, there's a lot of talk in the market about bond vigilantes, who are worried about the size of the budget deficit and the lack of potential buyers as the Fed continues to draw down its government bond holdings. Our proprietary technical indicator, meanwhile, which indicates the risk of a reversal in the yield uptrend, is only flashing amber at the moment and not flashing red. Over the longer term, though, on a 6 to 12 month time horizon, we continue to believe that bond markets are offering great value for investors. Remember that the labour market is a lagging indicator, and job creation data in particular is notoriously unreliable and subject to future revisions. Meanwhile, the ouster of US House Speaker McCarthy illustrates the challenges of future negotiations regarding any spending plans, which is likely to be a drag on the economy in the future. Therefore, we would continue to use bond yield spikes as an opportunity to add to high-quality bond allocations and lengthen duration. Before we wrap up, a quick note on gold. We argued in our weekly market view publication on Friday that gold is oversold and we would add exposure at these levels. Since then, gold has popped higher on the back of developments in the Middle East. Now, while geopolitical related bounces are often short-lived, the fact that this bounce comes from oversold levels suggests to us that this one may have more legs. That's all for today. Thank you for listening, and I hope to speak to you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.